or welcome back to our YouTube channel and our series, The Turning Point. I'm Valentina Sanchez Cuenca, and I'm with the Bird Shop board here in Latam. And today we're going to be discussing what has been going on in markets for the past week. For the past 2 weeks, we're going to touch base on some topics like NVIDIA, Apple, among others. Today we have our CEO, Larry McDonald, and we also have one of our longtime friend and contributor, Ben Bry. He's at Deductive Capital. So you guys, tell me everything about it.
Hi, it's Larry McDonald with the Bear Trap Support. We wanted to bring you, we've got this Bloomberg chat behind us that is the most compelling, I think, product in the institutional side of the business where we bring professional investors together. And the great thing is you meet people over the years. Our first book, A Colossal Failure of Common Sense, is now published in 12 languages. And we were close to 800,000 copies sold. The best part is when you come up with a bestseller, you go around the country doing a speaking tour. We met a lot of great people. And Ben Bry's here, who I have a lot of respect for. We have so many family office clients, hedge fund clients that we work with in our live chat. And I think this year, especially with the book coming out, our new book, When Markets Speak, I want to kind of address what the clients are saying. What are the institutional clients saying behind the scenes? Let's democratize information. There's people watching us right home now and learning about finance, but there's also veteran investors. So we want to make this podcast, more broad for a broad audience, but also we want to focus on, okay, where is the trade? What's really happening? So the Bear Traps Report produces a live conversation on the Bloomberg terminal with hedge funds in 20 plus countries. Ben Bry's here from Deductive Capital Family Office. I think we'll kick it off, Jose, with the first slide. Okay, so Ben, what I want to explain to you here, and you can I want to hear what your take is. The point I'm trying to make in the chat over the last couple of weeks is in 2021 and in 1999, both in 2021 and in 1999, we had kind of major tops in speculative technology plays. And I founded, I was fortunate enough with my partner, Steve Seafeld, we founded ConvertBond.com in the 90s. So we track very carefully convertible securities issuance. And it's a very telling thing because convertible securities are issued by CFOs. So if you're the CFO of any kind of technology company that thinks your stock is very high, like the SMCI now, which is the crazy company in the AI space. If you're the CFO and your stock's gone up 300%, you can come to market with a convertible bond. It's dilutive, but it's a great indication of where the CFOs think the market might be going. And if it's one company, it's not a big deal. But if you have a number of companies, and this week we had SMCI and we've had MSTR, which is MicroStrategy. So we have got two companies, and I'm sure I'm missing a few. I'm actually going to get on the phone. But I can tell you this. When you see companies coming to market in size with convertibles, that means the CFOs and the CEOs of those companies think their stock is expensive, and they're smart to come to market. And this happened in 1999. It was an incredible leading indicator of risk. There was a record number of convertible bond issues done. And it happened in 2021. You remember we had that crazy run up right before Archegos, right around the Archegos times in 2021. And there was a ton of convertible issuance with companies coming to market. So Ben, what we're seeing here is we're looking at high yield versus convertibles. And one thing I'm hearing in the chat, Ben, that I want to run by you, clients are saying it's because yields have gone up, it's actually a better business decision to issue equity and converts. And this is something that not a lot of people are thinking about in the market.
Yeah, it's interesting. I had this conversation with another group that I'm a contributor for this On the Street Pro with Herb Greenberg, just starting out. And we were just mentioning this, and every time it hits the tape, you're pointing it in the institutional chat. It's one of the great features of that, keep everyone up. But it's funny, before our call, I pulled up the board and, Sunrun, Lyft did one, Global Payments, NextEra Energy. I mean, there's, and like you said, MicroStrategy last night, there's a lot of guys coming out with this paper, and it usually tends to be toppy when supply comes online, right? I mean, one of the magical features of the America stock market is that we've gone from 8,000 issues to like 3,300, and everyone buys back stock. So if you look at the actual share count of the S&P, it goes down, and so you have that natural lift as the denominator comes down. But you start getting some supply on, that can usually be a turning sign. And there was a long time when I was at Fidelity and at the beginning of the family office, I did a lot of equity capital markets and convert stuff. And whenever the issuance calendar got hot, that was when you knew we were about to have a little turn. The bankers really like a strong market. And so, yeah, this doesn't surprise me at all.
Yeah, and this is a maturity wall chart. So all it says is there's two elements to convertible bond issuance. One is when there's a debt maturity wall, companies typically have to issue another bond to basically help mature the other. So they can come to market with cash and redeem the bond, or they can issue a new bond, and so that's like a refinancing. So that's one thing you have to watch out for. So if you have a big maturity wall and there's a lot of issuance, then that doesn't mean as much. Whereas if the maturity wall is this size, but the issuance is up here in terms of overall amount of capital coming to the market, that's a much more leading indicator on risk. Because at the end of the day, CFOs, when they see their stock is expensive, and this guy, Michael Saylor, the CEO of MicroStrategy, he issued equity at a really smart time in December. And that was a very good leading indicator for risk because the crypto sold off after that pretty violently. And then now he's coming to market again overnight. And so twice, this guy's come to market twice in a couple of months. For sale. And like you said, Lyft, I mean, look at Lyft. I mean, some of these stocks have up a lot. And so if you're the CFO of a company and you're looking at high interest rates relative to the last two business cycles, you're going to issue equity or converts. And when they come aggressively, retail investors, family offices watching us right now, you want to watch out for that. Next slide, Jose. So this is, after a slow start, the pace of global convertible bond issuance has risen materially. So you can see there, that's as of February 28th, and that's now up a lot since then. So, because the deals that Ben mentioned are not in there. I think Ben mentioned some of them were in there, but some of them are now in March. So you can see the dark line there, Ben, after a slow start, the pace of new convertible bond issuance has risen. And oh, by the way, you can see that 2021. That's what I was talking about. You know what I'll never forget is Viacom CBS, Ben. And this is such a great leading indicator. So the market, one of the things we were looking for in the market in 2021 when things were going crazy is this guy, Bill Wang with Archegos, right? And what Viacom CBS did was Archegos had basically squeezed Viacom CBS stock up so high that that Viacom CEO came in with a monster secondary in the middle of the night, and it basically I think that triggered the collapse of Archegos, because Archegos, then the entire street, saw this massive decline in Viacom CBS stock, and you can still see it to this day. It's an amazing transaction, and so CFOs in 2021, in that whole year, were piling in. As you can see that blue line, we're piling in with a ton of convertible issuance, and lo and behold, in 2022, all those tech stocks were off, I guess, anywhere between 20 to 75%, especially the ARK stocks.
What's interesting is, that back in 21, rates were very low, so this was a very nice way of doing it. Now I wonder, with rates higher, are they doing this to lower their cost of debt by giving some of the upside away? Or, as you saw on the last slide, there's so much paper that needs to be refinanced. Will some guys just be not able to do it? Do you know what I mean? Like if rates stay where they are, or even maybe go up, there's going to be some people who just aren't going to be able to raise equity. So maybe these guys are going to have to start raising equity. And I guess convertible is a nicer way to do it for some guys, less dilutive than just straight equity. But I think that
exactly. Yeah,
maybe
and
the
this
capital
is what
stack, it's just people get pushed down the capital stack essentially.
yeah, and this is what we exactly, and that's the thing is that if you have a market with a huge maturity wall and rates are higher, companies are incentivized to issue equity and converts. And so we could have, like, there's a situation today with Albemarle. One of the institutional hedge funds in the chat made the point that, a couple of years ago, ALB equity, Apple Larry Boy, is off a lot today. It's off like 10, 11%. And what's interesting about this, and he made the point, a hedge fund manager in the chat, the balance sheet they have is not that levered, but the cost of capital is high, right? And so they are choosing to issue equity to finance their capital expenditures. And think about like the last 10 years. If you were a mining company or any kind of company in the technology space and you had a big capital expenditure budget, and that's like investments that they have to make in new mining equipment or new mines, buying mine properties around the world, mining for lithium. If in the past you would just issue like a 2% bond and finance it that way, you go crazy. Now, this is something we have to watch out for in markets, because if we're going to come into a cycle, Ben, where companies that 5 years ago would have issued debt, but now they're issuing equity like ALB today, which is very similar to a convertible bond issuance. So they're financing their CapEx budget with equity, and that's dilutive, and that knocked down ALB equity by about, I think, 10 or 11% today.
Yeah, I mean, isn't that what the purpose of the equity markets was originally? Like,
way back
go
when,
back in time and why did people issue equity? Go back to the original Dutch East Indies Company, and when guys would, the first stock. I mean, it's meant for capital expansion. We've gotten to this point where the equity market no longer was for that. It was, capital distribution. There was no global growth for a long time, and you'd have little pockets like tech or crypto or little things, but we didn't. This is what's going on now, is maybe the first CapEx boom in 30 years, right? And while rates are higher, so it'll be, if I was an equity capital markets person, a banker, or I think that their days will turn up here in the future, because they've been pretty bone dry for a while, with the exception of a refinancing year like 21.
Yes, it's exactly. So retail investors watching us right now or listening around the world, you want to watch out for convertible issuance. You want to watch out for a debt maturity wall, where companies, if they have debt maturities, they may have to come to market with a lot of equity or convert in size. And that typically puts a lot of pressure on the stock when they, as you saw, MicroStrategy in December, if you look at MSTR equity from the moment Michael Saylor issued that, I think it was a convert, or he issued sold equity, you had a big reversal in the stock, very dilutive. And then today, the same thing. And we're seeing the same thing with ALB, same thing with Lyft. And so you want to keep track of this issuance of equity and convertible securities, because typically CFOs and private equity people, they know more than we know. I mean, they have the best information possible. And when they're aggressively selling their stock, and when you see a lot of companies doing it in the same month, the same week, that means something. You got to listen when markets speak. How to Listen When Markets Speak is our new book coming out by Penguin in 2 weeks. How to Listen by Market Speak. We hit #1 on the new bestseller list in finance in the last couple of days. So it's When Markets Speak, up on Amazon, and it's Penguin Random House. Will be in New York signing books later this month. Ben, tell me about your group with Herb. I love Herb, and one of the things that I want you to share with Herb was that this is, to me, is one of the most interesting charts. And one of the clients brought it up. We went back and we tried to find, okay, when was the last time you had a $2 trillion company that was trading 80% above its 200-day moving average? So a $2 trillion company that's trading 80% above its 200-day moving average. And we went back and we looked and looked. So you can't say what Tesla could have been, but it never hit 2 trillion, right? And so we look back, and I'll get into the maybe you can answer the trivia question, but we actually didn't find one. We found a couple close ones, but when a company gets that big, Ben, like $2 trillion, and it's 80% above the 200-day moving average, it's very difficult. And you can see the last time NVIDIA was 80% above the 200-day, the market cap was around 900 billion, so a little bit less than half, and that was last May. And so you can see here, it's very difficult for an equity. If you just think about the last 10 years of NVIDIA, right? Think about 10 years of NVIDIA, and it's very difficult to get 80% above the 200-day, and you can see how the equities just don't stay there that long. It's very, very difficult to stay there. But when you're talking to Herb and the team, what are you looking at right now when it comes to this whole AI craze and too much froth?
Yeah. Okay. Great. Yeah. No. Yeah. Herb Greenberg's a great guy. I met him when he was at his short selling boutique research firm. We had overlap on a stock, and we stayed in touch. And then he got up to me, and he's basically gathered a group of his guys that he likes, and we've started a group called On the Street Pro, and it's going to be a service where there's a broadcast and providing unique insights about stocks and the markets, and it's good. There's a group of people, we have a chat and talking, just like with us, but it's more of an interactive 12 people. And I have some of these, people have group WhatsApp chats, but there's been a lot of activity talking on NVIDIA, obviously, across the markets. And there's a couple of sharp guys in our group. And the numbers have been good, obviously. And the demand seems insatiable, and that they have the market cornered. I mean, and that must be obvious by their margins. So it doesn't
Tell me about the energy problem. Tell me about the energy problem.
Well, so, yeah, I was going to get to that. I mean, the reality is that LLMs are power hogs. They demand.
What are LLMs?
So the large language models, like what we're calling AI. In essence, these models are just gigantic regression models. They have billions of input or of parameters, and they're running the computer brute force against the parameters, and then going word by word, to sequentially predict what the next word's going to be, in more or less. And that's why they're still very mistake prone. But it's a bit like Bitcoin mining, in that a Bitcoin miner tries to solve the problem in order to get a reward by brute force trying to solve a very complicated math-like equation that eventually it will get. And who else benefited from the mining was, once again, NVIDIA, right? Because they have the chips that are needed for these brute force high speed calculations. So Bitcoin mining and LLMs are huge power hogs. Their amount of data centers that are going up is incredible. In Loudoun County, North Virginia, where 35% of all the data centers in the world are, the hyperscale data centers, they have something on their site that says the last 14 years, there hasn't been a day that they haven't been building a data center in that county, which is incredible. But if you go and you see Dominion, the large utility that's there, has actually cut off new data centers in the queue for that area. So if you're not in the queue, you're not going to get connected for the time being, because they're actually having capacity issues. And so if you add on all the manufacturing capex from the chips and the EV infrastructures and hydrogen fuel cells, and then $200 billion of planned data center capex, and the fact that these things need to run 24/7, it can't be surprising when you see the headline yesterday that Amazon secured nuclear power. They made a forward contract with Talon Energy to have capacity of their nuclear power. And Microsoft for years has been testing the small modular nuclear, and these guys are not concerned about the price. They're concerned about the supply, about having the availability. And so you wonder how this plays out. Will the big guys be, hey, we're going to pay up and get the supply, and what happens to the other guys. Because I don't know, unless there's a week, my buddy and I did a lot of research on this, and there's going to be a need for a lot of new power capacity, because it's not like renewables can meet this demand. They need a stable, steady flow. So that only means nat gas, coal, and nuclear. And,
Right.
It's not like it's easy to bring on nuclear power plants. It takes a long time. And in America, we haven't built one in forever. And so that just kind of tells you that coal and nat gas demand's not going anywhere anytime soon, and that the internet will now have its collision with biophysical reality for the first time in some senses.
Yeah, and that's the thing that I learned from the 90s, because like I said, I was fortunate enough to sell our convertbond.com to Morgan Stanley, Steve and I. And what my main takeaway from the 90s was that it was an incredible technology revolution. It changed the world, but a lot of the trades were like a lot of the first moving trades were infrastructure and global crossing and things that actually petered out. In some of the trades that were more lasting, things like Google or Amazon or internet companies that harness Match.com or whatever you want to call it, these companies lasted. And so a lot of times the big next trade, that's what we were getting into, like the turning point, is nowhere near as obvious as like what everybody's looking at. And that's why people are looking at now biotechs, people are looking at some energy companies. NextGen is a company that we position clients in Chemico, and so these companies in the uranium space. The entire uranium industry is like $42 billion, for the entire industry. It's like literally a rounding error in a NVIDIA bathroom. I mean, so this reminds me of like Tesla. Tesla was close to $2 trillion, and in order to sell those the amount of electric vehicles to justify the multiple, you need a whole new energy source that's more, like you said, more sustainable there. And sooner or later, that's what happened. The uranium space has really come on. We positioned clients in 2020, 2021, but getting back to Apple, like, so here's the thing that blew me away. So when Apple remember the SoftBank whale in September 2020, that was just an epic run up in Apple. And Apple had over a $2 trillion market cap. And just look at the sustainability up there. There's no oxygen. And there's a whole bunch of reasons why, gamma squeezes and all that. But what happened then was SoftBank had some crazy speculators that were buying options in the market. And they created this gamma squeeze where dealers were being lifted. In other words, they were selling people options. People were buying options from different dealers on the street. Those dealers had to go buy Apple stock. And at one point, the call skew was like 5-1, where there were 5 times more calls versus puts. And that's what created this incredible Apple was 66% above its 200-day moving average. And it literally just couldn't stay up there because for a whole bunch of reasons, which I think, Ben, you can get into, we can explain gamma squeeze. But at the end of the day, Apple's now 5% below its 200-day, 5% below. And NVIDIA is close to 80% above. This is something the generals are now breaking up, where this is the generals, we got certain generals that are in the emergency room. You have like Tesla, certain generals are in the hospital, heading to the hospital, like Apple, and then you have the other generals that are on top of the mountain.
Yeah, I mean, a few things. First, I wanted to go back and say that Bull Wang guy, he was doing the same thing, and Bill Wang, right. Whatever.
Now, we were the same thing. Explain to people what is the same thing. What does that mean to you?
We were short GSX, so I have firsthand experience with this guy. That was a fraudulent Chinese tech education company that essentially he cross-collateralized his equity with like 8 different banks running swaps, and which just means leverage, essentially, for anyone who isn't familiar with what a swap is. He basically had enormous leverage. He took $100 million and turned it into $20 billion. and then he lost it all on CBS. It's the best story. But yeah, essentially you can, in illiquid names where there's a bunch of potential energy built up, like heavily shorted stocks, they figured out that you can create buyers to unload your stocks to. And the most capital efficient way to do it is to buy out the money options. And honestly, to bring this back to power, if you remember February of 21, when Texas power prices went to $10,000 per megawatt hour, or Ethereum prices for sending it was at $300 to send it, there's a concept in networks where using that last 1% of the network, prices go vertical. They become completely inelastic because there's such demand for such a small percentage. And I think that's kind of what's going on in equities. I think there's some smart guys that have figured this out. And because there's so many good, smart quants out there who are doing stuff at a different level than people even understand. And if you have these small, like look at Tesla, right? Tesla was in a small, effective float for a long time, closely held by Bailey Gifford and my old firm and Elon. It was after they started doing all that issuance, and it was smart of Elon to do that. The price was high. It goes back to your supply thing. But since then, it hasn't been able to do that. So the key to the gamma squeeze is the supply side. You need to have it get to that last 1 percentage point where then it can go vertical, and then you control the narrative, because just like Bitcoin now, it's no one wants these things when they're cheap, like you do, Larry. Larry's the best. You talk about the nuclear. You were the guy who got me in Cameco in March of 2020, and what a home run stock that's been, or coal stocks. It's like when no one wants it is when you want to buy it. But it just seems that so many people are hardwired that they just want what works, and so when the price is going up, it then brings more people in, and so this dynamic feeds on itself. You have sophisticated guys. You have the retail narrative. You have the passive component of the market where passive doesn't really sell. So you only have a smaller amount of people who are discretionary and will actually arbit. So they all kind of work together. But what you see is it cycles through different areas. Like for a while, it was EVs and the clean tech stuff. And then it was crypto. And then that went away. And then now it's AI. Like you said, they did it with Apple for a little while. The meme, who can forget the meme stock craze of 21? So we've seen these rolling carry bubbles all over the market, and it's now pretty much a feature, honestly. And I was on the wrong side of this in 2020 and early 21, and I had to pay the tuition to learn exactly what was going on with these gamma squeezes and this new market dynamic. There really didn't, sometimes shippers would randomly do this, and there'd be a couple times, but it wasn't. Do you remember it being very prevalent before COVID?
No, it all goes back to what we're going to get into around too much capital chasing too few items. So Ben, when one of the things that we talked about in our book is when you don't allow the business cycle to function over longer and longer and longer and longer periods of time, there's no creative destruction, right? And so you build wealth, and then all of a sudden you have an election where, and I don't blame the Democrats. They want to stay in power. They don't like Trump. Some people love Trump. Some people don't like him. But I don't want to get into politics, but they want to win an election. The deficit spending is just literally, they're running $1.7 trillion deficits over a year. We've done one of the lines in my book, the Lehman and the response to COVID from Trump and Biden is a fiscal and monetary response of 15 trillion. 15 trillion. Fiscal and monetary. But we haven't had a recession since COVID. So that money is out there. Like you said, it's out there. It needs a place to go. It's flying into Bitcoin today. It was NVIDIA. Last year it was in Apple and Tesla. And so when you don't allow that business cycle to function over longer periods of time, you create these distortions. And that's one of the problems in the market. And when you look at Apple here, Apple had struggled at 66% above the 200-day. And I think we can go to the next slide, Jose. So Ben, so this is one of the most important things of this last 10 days is clients in the chat are talking about the secular change where with crypto and gold, you've got basically new highs on the same day. That's pretty crazy, right? And so it speaks to a number of things. Number one, it speaks to a lot of liquidity out there, which you get into. You're great on that. I would say it's very important that people realize that when you're hiking rates, right? So the Fed was hiking rates the last couple of years. They're driving up 2-year yields. See that? And every time they did that, every time they really aggressively hiked, they would, as you can see, gold suffered because why own gold when you can get, 3, 4, 5%, each month rates were going up and up in a 2-year note. Now, the key component of this is inflation expectations. So as the Fed is hiking rates, typically what that does historically is it brings inflation expectations down because people think, okay, they're going to break something. They actually did break the banks last year, and inflation expectations got crushed. So that hurts gold because once again, if you have $1 billion, you can put it in a 2-year treasury close to 5% or gold. And if inflation expectations on the 1-2 year are coming down, there's no real need. There's a less need to own gold. And so what's fascinating about this week is that the last since January, rates, as you can see that the white line in the top right hand corner, rates have gone up and gold's gone up. And it's very unusual. So you have a breakout in gold with higher rates. And from what I'm gathering from the chat and just my own research, the reason this is happening is that 5-year inflation expectations are becoming somewhat slightly unanchored. So inflation expectations are rising. And the Fed is already, all the Fed did, Ben, was open the door an inch, to rate cuts. They brought in this beast, this serpent in the market has taken off. They've essentially eased without easing because they're using their vocal cords. And that easing, that basically just talking about cutting rates has driven 1-year, 2-year, 5-year inflation expectations through the roof. And this goes back to the 70s. In the old days, gold would go up with inflation. But for 20 years, we haven't seen that, Ben.
Yeah, I mean, I have a different take on this in the sense of, I think that if you look at the ratio of the GLD to the TLT, so the long end of the curve, just as a simple way of doing it, because, bonds are a little wonky for a long-term time series. You've seen that ratio kind of stuck around 1. It oscillated a little bit for almost a decade from like 2014 to 2021. And since then, it's doubled, right? So gold relative to treasuries is dramatically outperforming. And what does that tell you? It tells you that people are starting to get worried about the government balance sheet. As
you're just talking about, Ben, you're just talking about the pure ratio of gold versus TLT.
Yes, the ratio of GLD to TLT is telling you that there's debt concerns. And by the way, it rose in the end of the GFC as well. Now, that was private credit. But I think that if you think about 22, you had the U.S., when you mentioned Biden, he did something political that had probably ramifications that are still not fully appreciated when they took the reserves of the Russians, which,
right,
is a little pirate-esque, right? And if we're the U.S. dollar reserve currency, it creates a dangerous precedent. So I think that since then, you can look around the world and central banks have been stealthily buying gold. And even JP Morgan, who's kind of been the ceiling on the gold price for a long time, apparently they've been added to the GLD as GLD custodian. And it's just steadily hanging in there. And to go to your point about real rates have been pretty high. I mean, 2-year real rates in last September were 3.3%. They're 2%. Like, gold's just chilling at $2,100 at an all-time high. And sure, real rates are coming in a little bit. But what happens if we get negative real rates? Where's gold going? I think it's going to be one of those things where people wake up.
Explain to the layman what are real rates. It's when it's inflation expectation.
Okay. So if government issues a bond for 5%, and Irving Fisher kind of was the guy who's famous for breaking down the composition of the nominal rate, which is the sticker rate you would earn, and it's composed of some real growth, which is typically people like to think of as 2%, but it oscillates some, and then 2 to 3% inflation. And obviously over time, we had almost no rates for a while. Now we have rates. In the 70s, we had really high rates. Things change. There's macro volatility. But in essence, real rates are what you care about. You know, you have to spend nominal, but that's actual purchasing power, right? That's what you can have a claim on the economy of, right? So all you really care about with money is the claim on energy or goods and services that it provides you. It's not like you can eat money or you can do anything with it. It's what you can do with money, right? And so if you're gaining money, but you're losing real, you're actually losing. And you can go and ask any Argentinian or anyone from Zimbabwe, their stock markets were up and to the right, and they weren't getting richer, okay? And that's where the concern lies. That's where people are saying, hey, Bitcoin is an alternative system. You know, gold is stood the test of time. It's stored energy, real assets. I mean, anything, you know, if the government is going to basically do this with this profligate, this deficit spending is outrageous, and the stock market and assets are responding, you know, and I think, you know, people like to talk about the Fed, but I really think what's in charge is completely fiscal. I think the Fed's a sideshow to the fiscal. I mean, if the Fed wanted to get serious and go up to 8%, it would matter, or 7%. But I think that the fiscal spending is the major driver of the post-COVID period. And if you think about 22, there's this image that it was just the Fed raising rates, but that really just hurt the long duration stuff. There was actually a year-over-year decline in the fiscal deficit of $1 trillion. And if you line up the fiscal stimulus impulse with the stock market, then they started re-ramping it at the end of 22. And they took that deficit back up to 1.7, 1.8. And what do we have? All-time highs again. So I don't know. I think the gold market is telling you something about the fiscal spending. I think the stock market's telling you that. I think the Bitcoin's telling you that. And, you know, unless we have some change, and no one's even talking about less spending. I mean, Trump's not talking about less spending. Biden's not talking about less spending. I mean, who's the guy who's going to come in and get this thing under control, you know? And one thing
the problem is, like, if Trump wins, Trump's a bigger MMT component as Biden is, and Biden's clearly doing it. Modern monetary theory is you aggressively spend on the fiscal side, and then you essentially hope that you create an economic enough boom to create the tax receipts to pay off the bill. I mean, that's
right. Absolutely. And I think that, you know, I chat a lot with a guy named David Dredge, who runs a tail strategy called Convex Strategies in Singapore. And he's a very smart guy. And he talks about this idea of who's going to buy the 40. And it's an interesting question because, you know, if you're being devalued, why do you want to own bonds over time? And there's lots of good historical cases for this. And so if you lose faith that the government's going to have some respect for the underlying currency, then you're just going to keep having rates go higher because there's going to be more money. And people want to use the old monetary lens, and that's fine. But I don't think that it even matters at this point unless they got really serious. And something you talk about in the chat a lot and you relay is that I think the market assumes that the Fed is stuck because, you know, we just saw New York Community Bank, and we saw last year around this time with Silicon Valley and First Republic and then Credit Suisse, that all the guys who were forced to buy the 40 at 1%, 2%, and buy those mortgages, they're sitting on a huge loss right now. I mean, the unrealized losses dwarf the losses of the GFC. Now, we don't have the derivatives quite and the funding weakness that we had then, so I don't know if it's as explosive, but that hole's there. And so one of the things you like to say is if rates go to 6%, what is Bank of America's leverage in that scenario, right? And like, so the Fed ultimately works for the banks. It's owned by the banks. It was started in 1913 to prevent bank panics. That was its original purpose. So if they see a bank panic potential, but then they see a government just spending money, they're in a tough spot. I don't envy Jay Powell at all. We'll see what he says tomorrow, but it's the market's saying that is what I think the market's saying.
And what drives me crazy is that you have economists that have their cottage industry, and they have to basically, all they know is economics. They're not risk people. They don't look at risk, right? And so they're in like a chalkboard, or they're in like a bubble, and they'll talk about things like, oh, higher for longer, and they just aren't doing the math. If you keep rates higher for longer, and you just look at the risk in commercial real estate, in auto finance, on the consumer side, what those consumers are up against, it just doesn't work. It's like, but if you could say higher longer in a bubble, or say you're on Mars, or say you're on a chalkboard, yeah, higher for longer in an economic sphere makes sense. But in a real world with risk, and that gets it back to what kind of like you're getting at around this fiscal. So they have an election to win this year in November. They don't like Donald Trump. He's been impeached twice, and now they have 4 court cases against him. So clearly they don't want this guy in office, and they will do anything in their power to keep him out. Now, if you think about the Fed balance sheet, we're up against the RRP. So we have Treasury is issuing tons of T-bills to pay for this $1.7 trillion deficit, right? Tons of T-bills. And they historically, they typically would have been issuing more 5 and 10 and 30-year notes. But they're issuing tons of T-bills. And when T-bill interest rates are elevated because the Fed's issuing so many, like today, there was another T-bill auction. It went pretty poorly because they're selling so many of these T-bills. And when the yields on those T-bills creep up, the RRP, which you could explain, comes down because the T-bill yields here and the RRP yields here. So money market funds, those types of investors are going to basically participate in T-bills and not the RRP, and it drains the RRP. And what clients are talking about in the chat this week is if the RRP drains too fast, that's going to tighten up liquidity. So, Ben, when you look at this chart, the Fed is supposed to be they're essentially tape. If you look at those, you see those red lines, how they're shorter and further apart, and there's actually been some green. That's a sign of the green is balance sheet expansion. So aren't they essentially already tapering the Fed balance sheet? And doesn't that mean we're probably going to be out of quantitative tightening by, say, sometime this year?
Well, I think that there is an element of when the bonds roll off. So there's some calendar issues with, okay, this is when it rolls off and this is what we have. And if we don't have any rolling off, they're not like, oh, let's sell the bond. They're not doing that. They're just saying, hey, we're rolling off we're rolling off when it matures, we're not replacing it, right? So I don't think it's not a linear process. It's, as you can see, it moves around. And so I think that,
let me just say one, I'm sorry to cut you off. I forgot to say one thing. The green line on the left, that's the banking crisis of 2023. So you can see the Fed was supposed to be in a quantitative tightening program, and that's where so when you see the green, that's balance sheet expansion. And we're not, they haven't formally announced an end to QT, but I just wanted to make people aware that green is where they had to come in and essentially bail out the banks.
Well, and that was something called the Bank Term Funding Program. And it was essentially a swap line where you could take those bad bonds that we talked about and get liquidity for them. Because I don't think anybody thinks the government's going to not make do, or these mortgages are not worth something. It's just that they're underwater because they bought at the wrong rates and then rates moved up. and so their value is just way lower in the marketplace. And so if you think about money itself, a bank, you have deposits and then they have assets. Well, if the assets are worth a lot less, that money's just not there, right? And so then people came in and got scared, and it was the first time I've ever seen like a Wonderful Lifestyle bank run, and they had to arrest that because that goes quick, right? Like that's like a wildfire. Like if everyone starts taking their money out of the bank, there's not enough money for everyone. Like the whole game of banking is a confidence game, right? You have to make people feel okay that their money's there, because in essence, there's not enough liquidity for everyone. And so they have to be okay with it is as it is, or you could do what the Italians and the Chinese do and not trust banks and have all your savings in your home or in gold or whatever. And so, the Anglos, are big in the banking. Eastern is not as much. But when you look at this thing, you see that BTFP is going to run off. They announced that's ending in,
So let's look forward, Ben. So if the Treasury is issuing tons of Treasury has an election to win, they have to finance all this spending. So the spending's, in theory, they want to keep us out of recession with incredible fiscal spending, right? 1.7 trillion this year. I think it was 1.3 last. So incredible deficit spending, 1.7 trillion this year, and probably about maybe somewhere in the neighborhood of the same. So they have to issue all these T-bills. T-bill yields are higher than the RRP. It drains the RRP. Let's get into what happens later on in the year. I mean, it's to clients. The argument in the chat is this creates a liquidity event at some point, and that'll force the Fed into QE out of QT. And that's what's interesting is Waller issued that paper. So on Friday, there was a white paper. If they go to QE sometime this year because of some type of banking liquidity event, that's gets you a weaker dollar, and that gets you a much bigger move in commodities and hard assets.
I think that's right. I think the market's front running that a little bit, but it's look, initially it's very liquidity positive though. Like the RRP was at 2.5 trillion and now it's sub the 450 billion. That money then is now in the reserves and it goes out into the world, and it's not being held on the liability side of the Fed's balance sheet. And so the initial move is a liquidity positive. But I think what people are talking about is that if it goes to zero,
the RRP.
Okay, the RRP goes to zero, and then, basically it's just in competition with T-bills, as you said. I mean, if it's better rate than T-bills, then people will go back into the RRP. It's not like it's a policy. It's just a window, like the discount window. You know what I mean? That offered a premium and now it's at a discount. But I think the real thing is if they keep running down the balance sheet, then you're going to get a point where what's the right reserve level? I think that's what people are concerned about. Are they going to take all this, post-COVID out? Probably not. What's the level they're going to take it to? What's the right level of reserves that keeps things from imploding and at the same time isn't super stimulative? And I don't think they know. I mean, I don't think there's any real right answer to this. I just think that, as you talk about, commercial real estate is going to be a drain in liquidity. You've seen that refi wall that you talked about earlier. That's going to be a drain on liquidity. The government has to refi $10 trillion this year.
Let's do that. So you got the government has $10 trillion to refi. As you can see here in 24 and 25.
New and refi. Refi plus the new issuance.
There's redemptions. We have to be careful. There's bonds that are coming due. So it's not a net issuance of 10 trillion because there's bonds that are coming due. Then they have to sell new bonds. But there's a ton of net issuance, and then you have this commercial real estate wall is about, looks like 1.5 trillion. And then you have the investment grade bonds, high yield, and loans, and that's close to 1.8 trillion. Next 2 years, I'm talking about 24, 25.
And there's a decent slug of corporates as well that, because think about the real there's a guy, what's the guy's name? cross-border capital, Mike Howell has talked about this, and he wrote a book called Capital Wars. And it's a very interesting concept of, it's all about the refinancing. There's all this capital in the world that needs to be refinanced. It's not new growth capital, as we talked about, the audacity of issuing equity for CapEx, but refine. And so the average maturity is around 3 to 4 years. So that's where every 3 to 4 years we get these issues that come up, and then we need to refi. And I think now we're there. And the question is, I think that all the bankers really would like to have lower rates, but if the inflation is, it costs $25 to go to McDonald's or, whatever, and the rate of change is not slowing enough, they're not really in a position where they can do that. And, basically, what do you do? What do you do here? Because this is going to be a liquidity drain, there's for sure. But the question is, the U.S. private sector household worth is like 155 trillion or something. You just wonder, will that have to come out of there? Do you know what I mean? So you question, will it come out of the equity market? Will it come out of some of these other areas that these people have their savings in? Because it feels like the banks are stuffed. It feels like the foreign sector isn't contributing as much as they used to. Hedge funds, maybe not. They're trying to make them primary dealers, some of them. But, it comes back to what I said about David Dredge's who's going to own the 40. I mean, it's just going to be a knife fight, is my view. Everybody's thinking there's excess capital, but we'll see. We'll see when everybody needs to refinance. Will it all get done? And will you get pushed down the debt stack or the cap stack? Will you be like, oh, sorry, you can't have the bank loan, but we'll give you the high yield loan, or you can have these new private credit guys who will charge you an extra couple hundred basis points, but you can get capital. Or, hey, here's my equity capital markets banker, you can issue equity. And, everyone gets slowly decked down. And what's the implications for the market going to be?
Yeah, and I was talking to a client in the chat yesterday. Double B CLOs are, this is double B now, CLOs, collateralized loan obligations, so baskets of corporate loans trading like 10% yield. And so I think what's happening is in the world, the boomers now have about 78 trillion of wealth. The millennials have about 8 trillion. So the boomers have 70, this is the stats from our book, When Markets Speak, but 78 trillion of wealth, but the oldest boomers are turning 79, the oldest boomer. But that means the average boomer is like close to 70. So the propensity of the boomers to own CLOs and bonds or T-bills or any kind of bonds or any kind of cash is high because they're older now. Whereas 10 years ago, the oldest boomer might have been, 64, 65. Now you're 73, 74 on the mid boomer, I should say, and the oldest boomer is 79. And so that sets up. And then if you look at one of the things we talk about in the chat, and we're hearing that certain regional banks, like what we call them, the super regionals, and so your Comerica's, your Zions, these are big banks, your U.S. Bancorp, they have a lot more exposure to commercial real estate than, say some of the big banks. And so you're seeing this incredible divergence between, a Jamie Dimon who has a team there, very sophisticated, has been able to hedge out some of the risk where stock's close to an all-time high. And the super regionals, some of them are underperforming the S&P over the last year by almost 50%, 50. So you get banks that are down 20 over the last year with the S&P up 30. And so that thing, as you said, higher for longer, here's the main takeaway of this podcast is if you're claiming you can go higher for longer, that's going to put some stress on consumer. It's going to put some more stress on the banks. And so if you're trying to go higher for longer to kill inflation that's sticky, there's a lot of things that can stop you. And that puts you into a world where the Fed gets stopped or has to slow down on hiking or can't hike anymore. They haven't really killed inflation. Then you're in a world where real yields are a problem because, like you said, you're only as rich as your yield after inflation.
Correct. I mean, that's the government's, right? There's the concept of seigniorage, right? And if Barry Eichengreen has a great paper where he shows how deleveragings have happened over the last 200 years. And the general strategy, you know, what they did after World War II is to have inflation higher than the nominal interest rate, and then they make not inflation, nominal GDP higher than the interest rate, and then they take the you know, the seigniorage, that's how they delever essentially, and it's a hidden tax on everybody, and no one wants that, right? Like this is a, and I think what's the real problem
is the only way out, though. The only way out when you get 35 trillion.
Or you can do the 30 style. See how that goes. You know what I mean? Like, I think that's what it is. No one has I just don't think it's politically, or anybody wants something like the 30s in a true deflationary bust austerity situation. So everyone's just going to inflate it. And so, okay, but I'm not sure, you know, we'll see. I think what I think is going to have to happen, honestly, is I think we're going to need the private sector of the boomers. By the way, I'm going to steal that mid-boomerish from you. That's pretty funny. You know, my father is an RIA, a firm called Buena Vista, and he has totally changed his strategy to being that he loves the 2 to 5 year window of bonds, and his clients are, you know, guys 65 to 85, and there's no FOMO amongst that group for NVIDIA or anything. You know, they're okay getting 5, 6, 7% and not having to worry about their port, you know, and not taking duration and, you know, just taking it low. It's a great strategy. They can just sit there and play pickleball all day or whatever. And so I think that'll be, those people are going to be bond buyers in the future, to your point. I mean, I think someone's got to buy them, and I think that's where there's balance sheet capacity. For the private sector, I mean, this is a speculative thought, but I've talked about it. At some point, do we deregulate the banks again? They're so over-regulated that, you know, they have their hands tied. They can't. Is there some point where, hey, we want to grow, we got a CapEx boom coming, we need banks to work once again, not just to buy government treasuries. We need to have private credit development again. Let's deregulate the banks. And the Japanese and the U.S. have the private sectors to do it. Household balance sheets are in massively better shape than they were in 08. There's been a massive deleveraging on the private sector. And so it might be time at some point here, you know, the government's led for 15 years between the central banks and the Treasury. Maybe it's time to like start going the other way and not just, you know, run $2 trillion deficits every year. Which,
yeah. Now, this chart, let's, you know, shift gears. This is the chart that wakes me up. This is our last. We're wrapping things up here.
Okay.
But in 2018, that wasn't that long ago, the spread between nominal GDP and the U.S. debt, total debt load, was about 1.1 trillion, right? And then what I talk about in my book was the response to COVID was 15 trillion of fiscal and monetary, whereas the response to Lehman was about 3 trillion of fiscal and monetary. So you can see there in 2020 that white line rips higher, and that's Trump and Mnuchin juicing things to try to get us out of COVID. And then there's Biden coming in after that, 2021, and then juicing things. And you can see we've gone from a $1 trillion spread between your total GDP and your nominal GDP and total debt. And now we're 28 versus 34. I mean, we're 28 trillion on the nominal GDP. We're 34 trillion. So it's like close to 6 trillion spread. What's going on here, Ben?
Well, you know, so I actually like that you did it like this, Larry, because traditionally what people do is they do debt to GDP, right? So debt to income, like think about it, net debt to EBITDA if you were a company. So the GDP is all the transactions of the economy, and the debt is the public debt of the government, right? No credit issues. Their default is inflation, right? That's their default. It's not like private sector. And so when we look at this, debt to GDP in 2008 was from the government debt as a percentage of the debt stack was like 18%. And it was like 60% debt to GDP. So you had a lot of capacitance in that where you could issue new debt and, we filled some holes and stuff, but it can be added to the economy because there's still capacity for the goods and services. When you cross the Rubicon of 100% debt to GDP, now you're just putting more money to the same amount, or growing at the real rate, which is why the real rate of growth is important, because basically, they are trying to paper over things. But the truth is, if there's no more capacitance in the economy, that we'll get what we get. We get $20 McDonald's and all the prices. The guys who had pricing power, they sure did a good job of executing it the last couple of years. And okay, well, what's it gonna, how's this gonna change? I mean, that's why everyone talks about there's only there's two things that could happen. You could have a productivity boom, and that's what I think people are hoping for with this AI thing. They're hoping that this is the savior, or nuclear fusion, or some kind of revolution in energy, maybe space solar. Or you need a lot of those older people to kind of just die, I guess. And that's a pretty morbid thing to say. But, otherwise you have this situation where, do you want to go through the pain?
Because you're talking about the amount of older people that need to be taken care of. And you're talking about unfunded liability.
Yeah, because if you look at the composition of the federal deficit, and you can go to the Congressional Budget Office website. I do that occasionally. I'm that kind of nerd. And you look at what they spend on. They spend on Social Security, and they spend on healthcare and Medicare. And the dirty secret of the healthcare industry is something like 40 or 50, or maybe even more. It follows a power law. Basically, then your last 6 months of your life, you do half or 60%. It might be even higher of all your spending in that period of time. So you have all these old people that are going to be huge drags on the budget. And by the way, we have what seems to be more and more global conflicts that, I think, Larry, the real answer to this is a complete restructuring of DC. And I have no idea how to do that. So I'm just pontificating here. But taking margins down for suppliers, taking a good look, what happened to us in Wall Street in 2008? That was a restructuring of Wall Street, and the margins and the broker dinners and everything that was, the heyday pre-GFC, it just didn't come back the same way. There was a total restructuring of how Wall Street worked. And there's some of us who are still left, but it's nothing like how it used to be. And maybe DC and all the guys, the lobbyists and all the people who have their money and they're getting money from, because somebody's making money off this. There are companies that are making big money off this. Maybe we need a restructuring of how we're doing business. And some of this is just margin. But then again, that's bad for the S&P. So there's a price to pay for everything. And it's going to be a decision of who's the winners and losers here, essentially.
Yeah. That's a great way of looking at it, Ben. And, this is a really important discussion because it really embraces the core thesis of our book, When Markets Speak, up on Amazon. Ben, it's been great to have you here. And, I think that having clients like you talking about ideas during the day, where's the trade looking forward? We're trying to come up with, okay, we're all facing markets, changing markets, different asset prices, but trying to figure out, okay, where's the trade? How are we going to play the next, 5 years, 1 year, 6 months? And I really appreciate you being here, and give my best to Herb and the team. Yeah,
and everyone should go out and buy his book. It's fantastic. It kind of echoes what we're talking about, and it's very in line with a lot of my thinking. And I think that, things are changing. And again, Larry's always been a great guy at the turning points and the inference points. 2020, he was one of the few of us who was pounding the table to buy energy. And what's coming up with commodities is an interesting change in dynamic versus what we have today. And it'll be worth your time to read Larry's wisdom. So thanks for talking. Good to see you, Larry.
Good to catch up. And it's When Markets Speak, and Valentina will take it from here. Thanks.
Thank you, Ben, for joining us, and thank you so much for such great insight, guys. Everyone, the team is taking over New York in the next 2-3 weeks. We're gonna have multiple events. We're gonna have a private book launch. We're gonna have book signings all around town, and we're gonna have an exclusive event with our partners from ACG Analytics about the 2024 elections. If you're interested in any of these events, please reach me out at valentina@thebirdshopsreport.com. That's valentina@thebirdshopsreport.com. Also, I don't know if you saw, but Larry had this beautiful bloomer chat with him all over the video. If you're interested in having a channel on that, you can also reach me out at the email that I previously mentioned. And please remember, our book is coming out on March 26th. And please, you can find the link below and you can grab a copy immediately. Thank you so much for watching, and see you next week.